So I introduce my husband, the tax strategist, Adam Lippman.
Thank you all for coming today. I really appreciate it. Okay, so this is the fiscal cliff notes. We're going to try and give you the real juice of what this is really all about today, and what this means for you and how you can use this information and pay the least amount of tax as possible. Okay, so this is legal stuff. You can read it on your own time. Okay, so let's talk about the goals of this seminar. Now I know, as much as you're here for me, you're really here for you. You're here for you to save more money. You're here for you to make more empowered decisions. You're here for you to benefit. And I understand that ultimately for this seminar to be successful, this has to be solving your questions and your needs and your problems. In order to do that, I want to go over the major points of the fiscal cliff deal. And we're not going to go over all the details because they're boring, they're minutia. A lot of them don't even apply to you, but we're going to go over the main things that do. The other thing we're going to do is we're going to talk about the effects of Obamacare that's starting in 2013. So everybody talked about the fiscal cliff, but nobody's been really talking about the additional Obamacare. Again, this is related to the Health Care Act. Actually, you probably are very aware of that. We're also going to talk about the winners and the losers, because in every single deal, there's people who benefit and there's people who do not. And another next thing that we're going to be talking about is IRS updates. Oh, thank you. Hey.
Hi, Adam. How are you?
Good. Come on. No. Love everybody. We're going to be talking about IRS updates. So one issue is taxes are going to go up. So that means the compliance is going to also go up. We're also going to be talking about California issues. Because if you think the federal government is broke, the state of California is way more broke. Because the federal government has the ability to print money. The state of California does not. So we're going to be talking about the tax prep issues for this upcoming year, and then I'll answer any questions you guys have. Because I do want you guys to benefit. I want you to walk away here having this benefited you. And I'm so grateful you came on a Sunday. I understand you had many options available to you. So let's make it worth it for you guys. Okay. Now before we talk about the specific tax law changes, you have to understand, I want to give you a little context of what's going on. And none of this will be surprising to you. None of this is shocking. This is just putting a bow tie to make this all make sense to you. So the government is broke. We all know that. Baby boomers are about to place a huge financial stress on the system. We all know this. It's like the Social Security, the Medicare. We all know that. Here's where it gets really interesting, is that most of the wealth is in the baby boomers, right? So not only are they going to cause a lot more expenses, but they have the money. And what I'm seeing in my practice and across the board is we're living in a world of the haves and the have-nots, right? So the rich people are getting a little richer, and the poor people are getting a little poorer, and everybody in the middle has got to make a choice where they want to stand. And it has to be an active choice. And the last thing, that an overarching theme is 80-20. Okay, have you guys heard of 80-20 though? Yes? No? No? Okay, it's this kind of like this reoccurring pattern in nature. And it goes like this. So in business, it gets like this. 80% of your revenue comes from 20% of your margins. Or another way to look at it, this is women might, you ladies might enjoy this, is your clothes. If you go in your closet, you have a big closet, right? And I bet you probably wear about 20% of your clothes all the time. It's like shoes. You have a bunch of shoes. And you wear the same ones over and over again. Okay? The federal government also understands this idea. Who do you go after? You go after people with money. If you want to raise taxes, you do not do it on people who are already broke. There's no money. Right? So you go after people who have money. Does that make sense? These are the overarching themes, and we're going to see how these themes get applied to the tax code system. All right. Okay, so let's talk about the major points of the deal. So what you'll notice, and this kind of incorporates these overarching themes, is that all the Bush rates are now permanent, okay, except for people in the higher income stratosphere, right? 400,000, 425,000. On the surface, this looks like it won't affect hardly anybody, and in fact, the amount of people this affects is very, very small. But again, it's the start. It's all about this idea of going after where the money is. Okay. Now this one affects probably almost everyone in this room. And this is the payroll holiday. There's no more payroll holiday. So if you're living paycheck to paycheck, you will notice this. You will, it's a 20 bucks here, it's a 20 bucks there, it's gas money, it's beer money. You'll notice this. Okay, so people did get hurt by this. Now this was kind of cool right here. So capital gain rates have now been made permanent, except for the people who are in the upper income ranges. So example, if you're making over 450,000, your dividend rates are going to go up. Your capital gain rates are going to go up. Okay. However, if you're in the lower echelon, you're fine. You're fine for now. Okay, so this one has to do with business people. 50% bonus depreciation has been enacted for 2012, and it's going to be going forward. And that was part of the update. And then if any of you do depreciate assets, you get up to 500,000 over there. Now this one was a major one. Had this not been passed, all of you would, I think I know most of you fairly well enough to know that this would have affected almost everyone. So there's something called the alternative minimum tax. So that's if you pay too little tax, the government says, no, we're going to add some more tax onto you. It was going to drop down substantially, but then they patched it and they made it so it won't affect too many. And here's something else the government decided to do. Phase out of deductions at AGI. So one issue, right, is your taxes. One issue is you have your tax rate, right? And that kind of changed. Another thing is, at what point are your tax deductions still allowed to count or not count? And so they're going to start phasing out at those amounts. Now there are some exclusions in that. No point in talking about it. And this was another big thing, and I was wrong about this one. This one passed. I was wrong about this one. Okay, a lot of people, and maybe either you or a friend, all of us have been affected one way or another, with people who've lost their homes or their rental properties. We all know somebody. Unfortunately, I know a lot of people. What they allowed, this law was going to expire in 2012. And what that meant is that if you had a cancellation of debt in your primary house, you'd have to pay taxable income on that. And that would be a lot of money. So for example, let's say that you're upside down 300,000, they issue you a cancellation of debt of 300,000, boom, you now have to pay tax on 300,000. Most people do not have enough money. If you're already broke, if you already lost your house, you don't have cash for that. So the government decided to extend this. I was surprised. I didn't think they'd do that. But they did, so that's cool. Although the state of California does not conform to this as of today. Because remember, there's federal issues and there's state issues. So just because the federal government says it's okay, the state of California does not. And remember, they're broke. So I don't think they might extend it, they might not. Who knows? All right, 15-year depreciation of real estate. Let's see, real estate. Yeah, all right, there's a couple of real estate people here. 15-year depreciation for real estate. So that's kind of a good thing. This would have affected almost all of you in this room. So originally, before the fiscal cliff deal, the estate was going to go down from $5 million to $1 million. So if you had anything over $1 million, you would have had to pay tax on it. So what they did is they increased it to $5 million. And if you have a spouse, it goes to $10 million. But what they did do is they increased it up to 40%, anything after $5 million. Remember, it's all about going after the money. Whoever has the money, you take them. The biggest thing that actually affected you in this deal was the state income tax deduction, or at least for a lot of clients. So if you actually look at your Schedule A, anything you pay to the state government, you get to use as a tax deduction on the federal. Originally, that was going to go away. It was going to go away. And for a lot of people, that's a really important item. But they actually kept that one. So hey, that's cool. So these are the major points of the deal. Again, when you look at it, you're like, God, I don't think that affects me. But again, this one affects everybody. This one would have affected everybody. This one, if you have any friends who are going to lose their house, let them know that they're not screwed. You know. By the way, if some of your friends have a second or third property, or if they have a rental property, there's additional exclusions called the qualified business indebtedness exclusion. So there still is hope for them. You're not screwed. Is there any kind of questions here?
Explain to the bonus depreciation, I'm not.
Oh,
understanding
good
that.
question. So let's say you were to buy a computer. So there's two types of ways you can depreciate things. You can do a section, okay, actually there's many ways. Okay, let me scratch that. There's something called Section 179 and then there's bonus depreciation. There are two types of ways you can depreciate something. For your purposes, one depreciation will cause a loss if you go negative, and one is limited to zero. So let's say you earned $100,000 and you bought something for $200,000. With Section 179, you can only go to zero. That's all, the only thing you can do. But let's say with bonus depreciation, you can actually get a loss. Yeah. Well, that's there are many types of depreciation, but that's kind of the basic. Okay, now this is something I really want to talk about because this will affect all of you at some point. Whether it's not 2013, it'll certainly be in the next couple of years, I promise you. Okay, so we all know about the Health Care Act, Obamacare. I don't say it derogatory, it's just easy to say instead of the Affordable Health Care Act or something. Okay, so this is how this works. This got no publicity, in my opinion, and it will actually have the biggest impact on baby boomers. Okay, so there's two things that are going on here. One is there's a 1% increase on earned income above a certain threshold. Now I know what you're saying, well, you know, 250, 125, that's not a lot of money. No, excuse me, that is a lot of money. This will probably affect a lot more people than anticipated, especially in the state of California. Because if you're in Oklahoma, you know, that's not a lot of money. In the state of California, these aren't outrageous amounts. But here's where it gets really, this is the one that's going to hurt a lot of people right here. It's called net investment tax, okay? So I want you to picture this for a second. You are about to sell your rental property and you're about to make a profit, right? If you make, and usually if you hold a property, so most people are not selling any property right now. It's the market. So you're going to hold it, you're going to hold it, you're going to hold it. You're probably going to hold it for 10, 15 years, right? That's what most people do. So when you sell the property, you're going to have a huge capital gain, right? What this is saying is that you have to pay an additional 3.8% of tax. It's an additional amount. Okay, so remember, this is going to apply to dividends, rents, interest, stocks. This is where it's going to really hurt a lot of people is on stocks. So remember, think about it. You've been saving your entire life. At some point, you're going to cash out. At some point, you say, screw my kids, I'm going to have fun. You know, I don't want my kids blowing it on inappropriate things. I'm going to take my stocks, and I'm going to just liquidate it. You're going to, you'll be subject to this. Another thing, this is a very interesting thing, is passive business income. If you're part of an LLC, you know, it's I think there's, a lot of people are going to be hurt by this.
Question?
Yeah.
What is MFJ, MFS, HOA?
Oh, great. Okay, great. Thank you. Okay, so it's married filing, joint, married filing, separate, or head of household. Yeah, so, okay, great question. So the thresholds have to do with your filing status. So depending on your marital status, you get different thresholds. It's like how many beers you can drink. You know?
Excuse me.
Yeah.
So one of those thresholds, I'm sure is different for different statuses. But for example, let's say capital gain on the sale of the property. What's the threshold that will they'll have the 3.8% kick in?
Oh, great question. So it's these right here. Oh, yeah. Oh, thank you. Yeah. I kind of ran out of space. Great question. Thank you. It's going to be the same as these ones. It's going to be the same as those.
Can you give me a scenario on that, like walk me through?
Yeah. Okay, great question. Okay, so this would be a classic example. Can I use you as an example?
Sure.
I won't get too detailed, but let's say you're like, Alexis is gone. I want to travel the world, right? So you sell your rental property up the coast, right? And okay. So, oh, actually, you know what? Actually, let me go to this one. It just kind of deals with this. I'll just skip to here. So let's say you bought your rental property a long time ago, in the 60s. Oh, sorry, I'm wrong. Probably like 70s, 80s?
Sure.
90s?
Yeah.
Or whatever. I don't know. Whatever it was, you probably paid very little for it. But today it's worth a lot of money, right? So anything over, you're probably going to make over $250,000 of profit. you're gonna have to pay an additional 3.8%. Now here's where it gets really screwy and unfortunate, is let's say you'd refinance. So most people who had properties have refinanced 1,000,000 times. So on paper, you're gonna have a gain, right? So you take your sale price minus what you paid for it, and that's your profit or loss. But when you add in the fact that you've refinanced 1,000,000 times, you're not making any dough at all, because it's all going to pay mortgages or refinance, whatever. Those are the people that are gonna get hit real bad.
Hold on. So let's say, for example, if you owe, I'm just throwing numbers out. Let's say if you bought it for 400,000,
Okay.
but you've refinanced, taken money out of it, now you're at 800,000
Okay.
because you've been stupid. Anyway, so then it sells for, okay, 1.5 million. So there's, what, 750,000 extra. So you're paying explain it to me on that then. Give me the
Okay,
numbers.
so you said what was this?
Let's say 1.5 and you owe
1.5. So you do 1.5 minus, what was the sale price? Or what was the cost?
the cost that you purchased it for, or the cost you refinanced it to?
The cost that you bought it for.
Let's say 400,
400,000. So you made 1.1, right?
technically.
Okay, so you'd be paying, so remember, there's several different issues here. Remember, first off, you're gonna pay the capital gains rate, which will be 20%, okay? So remember, this is gonna add, okay, just to clarify, there's different levels of tax, you know, and they all get stacked on top. It's kind of like a super supreme burrito. There's just different layers of it, okay? First off, you're gonna have your capital gain.
Right.
That'll be 20% for you. Plus, you're going to add on another 3.8 on the 1.1. Okay, that's some dough. And remember, if you have a rental property, you have to add back depreciation too. So it's
So don't sell your rental properties.
like your kids. No. We can talk about what we can do for you. Did that kind of answer? Oh yeah.
So that's the exclusion of 250, 125, 20. That's per year exclusion.
No, that's the threshold to get into that club. So this doesn't kick in until you've gone over this.
Is that on an annual basis though?
Yeah.
Okay, so what I'm thinking is if you have a lot of stocks and there's a lot of built-in gain in it, couldn't you just stagger your sale of your stocks so that you don't go over per year?
This is where tax planning is going to be very crucial. You're not going to be able to have an impulse buy or an impulse sell. You're going to have to really think about when you want to do things and how you want to do
Yeah, you might not be able to do it for one single piece of property. You can not sell it piecemeal, but for stocks and bonds and other divisible assets, you might be able to do that, plan it out.
Yeah, so he shared with me, he's in derivatives. That's like your field of area, right?
Yeah.
So those people have a lot of gains. So they're going to, it's all about going after people with money. So a lot of these day traders are going to get really hit by this. They really want to go after those people. Yeah, really want to go after those. Okay, so let's just talk about winners and losers. If you just have dividend-only income and it's very small, you're going to be okay. You're going to be okay. If you're in big, what? Oh, TB stands for taxpayer. Taxpayer. It doesn't have toilet paper. I didn't even think about that. I heard it. Okay, fixed income. If you're like a low income earner, Social Security, don't worry about it, you're fine. If you have a W-2 salary with very little deductions, so these would be like your Google guys. These are like your 20-year-olds who are making a lot of dough, and they got no house. They're not getting hit. They're not getting hit too bad. If you have capital, if you're the type of person who's just going to stagger out your stock sales, you're going to be fine. Okay, now part of the compromise of this deal are you guys familiar with earned income credit? Wonderful program that helps millions of people. So they've extended that for 5 years. So that was Obama's big victory. That was his big victory. That was his big get. His big one. So they're actually going to increase that. So if you're a certain threshold, basically the government just gives you free money.
Can you explain that a little more, please?
Great question. Okay. So let's say here's the classic example. You're a single mother. Let's say you got pregnant in high school, you're a single mother, you're working at Starbucks, you make $10,000 a year, and you can barely survive. You're living at grandma's house, mom's house. The government, depending on how much money you've earned, will give you about $5,000 for free.
Nice.
Yeah.
Love it.
Yeah. and depending on how many kids you have, so honestly, it is a wonderful program. It will, like all programs, it can be abused, but this was his victory. He can go to a lot of people and say he got this passed. And for his, by the way, I'm politically, I'm very neutral, but for his people, that was really good. For his core base, that was a big get for him. That was a big get. But remember what he gave up though was, remember Obama originally campaigned on $250,000. Most people do not make $250,000. Most people do not make $450,000. And what's amazing is, so the difference, so you guys ever go skiing, right, and there's snow? Every couple hundred feet you go down, the snow doesn't go down like, it's not a linear equation, it's exponential. There's a lot more people at 250 than there is at 400,000. A lot more. So so the Republicans are like, oh man, we increased taxes. Oh, it's horrible. The reality is it affected hardly nobody. 250 would have affected a lot of people. So that was a compromise. So everyone kind of won. We'll talk about the long-term impact now. So let's talk about the losers really quick though. If you're making money, it's hard to be wealthy in this world. This system is not designed for you to make money. No, they don't like you. They want your money. And then if you have ex-wives, it's even worse. Okay, rental properties. Eventually, you're going to want to sell your properties, and so that's going to hurt. A lot of baby boomers with large capital gains are going to get hurt if you're selling your property. Okay, let's talk about selling your property, because a lot of you have homes that you bought a long time ago. This will apply to your personal homes too. You still get the personal exclusion. So it's $250,000 or $500,000, depending on how long you've been married. But anything over that exclusion, you're going to pay the additional, you're going to pay the 20% capital gain rate, plus you're going to pay the additional 3.8%. So that's a bummer. And I'd imagine a lot of you in the next 10 to 15 years are going to want to downsize your house. I would imagine that's probably pretty common. You don't need a big house, your kids are away. Okay, let's talk about, another person who's going to get hurt are charities. They're going to get hurt really bad. This is an unintended consequence, by the way. Because what's going to happen is the phase-out deduction, right? People usually do things because it benefits them. And we all believe in God, maybe, I don't know, whatever. Some people do. Or you believe in your cause, dogs, whatever. But you do it partially for a tax deduction, right? Right? Doug, I don't know, he's like, he's part of a charity. A lot of it has to do with tax. It's like, well, hey, I get a tax benefit. But what's going to happen is as people start getting more and more money and their deductions start phasing out, there's going to be no tax benefit to donate. Okay.
When you talk about the rental properties, are you talking about rental income or are you selling the rental property?
Oh, thank you, sir. Yes. Excellent. I wasn't clear about this one. Your rental income is also, if your profit or loss, let's say you make over $250,000 on your rental property, you will be subject to this. So for example, I have a lot of friends who are in syndicates, like they own medical buildings. Like, you go on downtown Wilshire Boulevard, they own those buildings. Remember, the government is going after people who have money. They're going after people who have money.
Yeah. That, $250,000 per exclusion for the net investment tax. Is that all of those different sources of income combined, or are they looking at it individually? Like, do you have to make over 250 in selling your stocks in order to? What if you make 100,000 from rent, and then 20,000 from stocks, and then 10,000 from interest?
From what I understand, I'll be honest, I can't say this 100% certain. So I'll just say that right now because I'm still learning this. I believe it's on those specific ones. I know it's these specific categories, but let's say I do believe these net each other out. But I don't know for sure. I don't know. A lot of these, the IRS is still coming up. So they enacted all these rules so quickly. They never gave a, so when Congress passes a law, they never say how to apply it. I'm being serious, they don't. They just say these are the laws. The IRS has to come up with the regulations. They're currently coming up with a lot of them.
They write the codes, they.
For example, like another example is S corp. I mean, I don't want to go into it too much, but in S corp and LLC, it's like, well, is that passive or is that active? You know, I mean, you can make an argument either way. So,
What is an LLC?
limited liability corporation. The real estate industry. Okay, this is another example of as the deductions become less and less available, the mortgage interest benefit just is not as good. That makes sense, right? So everyone says, oh, I got a house and there's no tax deduction. What happens when that tax deduction goes away? You know, the real estate industry on the high end will suffer. If you're a working stiff, you're going to be hurt too. The payroll, the 2%, it will affect people. In the last, this is really the group they're going after though. I really want to focus on is boomers looking to cash out. Because remember, 80% of all the wealth in stocks and mutual funds is owned by baby boomers. And they're going to be cashing out in the next 10 years for sure. So they're looking to go after that money. So again, these are, some of the tax planning issues would be a staggering stock sales. It would be if you're going to sell your business, there's certain ways you can restructure it. We don't have time to go for that today. But there is certain things we can do, but it has to be done with care and diligence. And it can't be done, if you're in a situation where there's a fire sale, you're really screwed. I would also mention this, is that if you do not, how many of you guys have a living trust here? Living trust? I fundamentally believe anybody over 40 with over $100,000 of assets should have. Because what will happen is when you die, your kids are going to want to cash out really quick. Mom and Dad are dead, I'm going to Vegas. You know, I've seen it, trust me. I've seen it. They're going to be paying a lot of tax, plus there's probate.
How about a property that was sold last year, but then through legal action, there's a payout this year?
When will be the date of the sale?
June
Of what year?
last year.
You'd be fine. You'd be fine. It's really the sale date that counts. Oh, yeah.
Question. I know Corey has a living trust, but when I had asked Rick about me having one, he said, because I don't own the property per se, because it's in his name, I don't need a living trust, I just need a will.
First off, see a lawyer. You should really see a lawyer. Okay, so people's lives are totally changing, right? People are getting married in different places, and there's multiple marriages, and there's different types of marriages, and then who gets what at what stage? Do you give it to your kids? Do you not give it to your kids? That's something we really got to talk to a lawyer. And remember, this is about probate. This is the big. Okay, so just let you know, everybody, the real issue with getting a living trust has nothing to do with the estate exclusion. It has to do with probate. If you have over $150,000 in assets and you do not have a living trust, you're going to go through probate, which is utter hell. Utter hell.
My parents, when they
Utter
passed,
hell.
went through that.
And the thing, here's where it gets really complicated, is when you have different levels of marriages, like who gets what at what time. It's a big problem. And the other problem that I've noticed, I don't know if you guys are aware that due to budget cuts, they've just closed 4 of the probate courts in Los Angeles.
Wow.
So here's practically more people are going to die in the next couple of years, and there's less courts to handle it. So it's going to take forever. And the only person that's going to win are the lawyers. So you can either pay a lawyer now about $3 grand, or you can pay another lawyer later about 20 grand. It's your choice.
Can I add something
Yeah.
to the will? When you consult the lawyer, make sure it has a pour-over provision.
Yeah.
A what?
A pour-over provision.
Yeah.
It pours over into a trust, so you avoid the probate.
Yeah, that's it. Yeah, thank you. Thank you. I couldn't say that because I don't give advice.
Adam,
But he's right, though. Yeah.
you talked earlier on a couple of different screens ago, it was regarding in the world of real estate. Are we going to lose our mortgage deduction?
Oh, okay. Let's talk about this one. Okay. Okay, so this is actually, thank you. This is a great transition.